Hello, and welcome to this week's edition of Wealth After Work, the show dedicated to bringing you in and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio, we have Josiah Grasso. He is the Vice President and Senior Investment Advisor at ASC Financial Group, and Senior Investment Advisor Taylor Munoz. We're so glad you're joining us today. This show is dedicated to providing you with retirement planning solutions. We love spending this time with you each and every week. Josiah, Taylor, I love spending this time with both of you. How are you?
Doing great.
Yeah,
I did want to let both of you know I'm only drinking water this time and not coffee because last week I think the hands were going wild. I'm pretty sure I saw Taylor duck at one point.
He was doing this a couple times,
I mean, the nice thing though is it was a little warm in the studio and it was like a fan.
Right.
And
Just kind of cool you off.
I felt really cool the whole time.
Well, look, we've got a lot of fans at home that come and talk to us, so I figured why don't we get fans in the studio here, so it works out.
The jokes are never ending with you two.
Sorry.
I never know what I'm going to get. I love it, and I know our viewers do as well. But one of the other things I really appreciate about the team of ASC Financial Group is their commitment to providing all of you with solid financial education. And we know that there's a lot of questions, a lot of concerns out there, especially in light of today's economic headlines that are happening, and we want to make sure that we educate you all properly on all the different financial tools that are available in the toolbox, the strategies that you can use to help your clients, which means we have to talk about the A word, which is
Annuities.
Annuities. Okay, so before you might be tempted to change that channel, we encourage you to stick around with us because here's the reality. There's a lot of misinformation. There's a lot of misconceptions out there. We're going to peel back the curtain today and look at annuities, the good, the bad, and the fine print, and really helping you determine, could an annuity, the right kind of annuity, possibly be right for you? Because not all annuities are created equal. So we got to have this conversation. And really, there's been a huge rise of interest in these products over the last several years. So let's talk about that.
Yeah, Kristen, something that was a really powerful statistic to me, I just read recently, I got this newsletter, and in it, there was a study that was conducted last year called the Annual Retirement Study or Annual Retirement Report. And it's done, I believe it's done every other year. And last year, they said 63% of respondents said they were more concerned about running out of money in retirement than they were of death. I mean, that's a powerful statistic. It was up from 57% the last time they did the study. So there's this increasing fear about what the future holds. And that's due to a lot of things, the impacts of inflation and geopolitical concerns and the market's volatility. We have historically low tax rates now, which some folks, believe that means that we can only go up from here. So increasing taxes, there's a lot of things that lead to that uncertainty and that concern.
Right.
Another big thing is that we're living longer than we've ever lived before. The average life expectancy is tipping 80. It's, once you make it to 65, the average life expectancy even creeps up from there to the mid 80s. And there's a 1 in 2 chance that out of a couple, one is going to see their 92nd or 93rd birthday. So we're planning for 30-year plus retirements, which is a big concern for folks in terms of how do I take what I've accumulated and what I've built over my career, and how do I take money from that now and pay myself a paycheck in a sustainable way?
Right. Yep.
So when we look at the overall income picture that folks have, there's 3 pots of guaranteed money. Social Security, pensions, if you're fortunate to still have one, and annuities. And annuity is just a fancy word for a contract. An annuity is a contract with an insurance company, and Josiah will talk more about it later. Not all annuities are built equal. We'll talk about what you should look at when you're evaluating that. But if you don't have a pension or you don't have enough of a pension, you need other guaranteed income to fill the void to make sure that your necessities during retirement are covered with guarantees.
Right.
And so that's what a lot of folks are turning to. It's really worth a strong consideration for a part of one's retirement strategy. So and for those that are very concerned about market volatility and risk, and we talk all the time about maximizing income in retirement and not worrying about the ups and downs of the market. It is a powerful tool to put in the chest of income for those that are looking for that predictability and certainty when they're in retirement. We don't want a retirement on a hope and a prayer. I hope I do well. I pray that we make it through. We want predictability. We want certainty. And in this case, we want some guarantees for what income is going to be there.
And I love this. I know you always say that annuity is simply a fancy word for what?
A contract.
A contract with an insurance company, right? It's contractual. And I think providing that predictability, providing that certainty and protection of one's wealth, that's really what a lot of folks are looking for, which is, I think, why these products have become a lot more popular. The right kind of annuity, that's the key, right? And so that's what you really want to do, is you're trying to help your clients capture as much of the upside as possible, but not subject that money to the downside risk, right?
Yeah, absolutely, Kristen. I mean, some of these contracts here is, we look at some of these safe growth annuities. We could participate in that market upside at some rates of 40, 50, 60% of the market upside. Some of the caps we've seen are 9, 10, 10.5%. We've even got some of these fancy ones that are what are called trigger driven. As long as the market is positive at all, they're going to give you an 8.5% return. And so the key is with all of that, though, is we love making that market upside, but the key is that we don't have any of that market downside. Okay? And so that's why the reality is the right kind of annuity may be a good spot for a portion of your retirement savings.
Yep, and so that's the key, right? It's not all of it. It's a part of it, and it's an important financial tool to accomplish those objectives if it fits someone's certain situation. So let's now go through the basics and talk about the different kinds of annuities that exist, because all three of us here at this table, we know that not all annuities are created equal. So let's go through the different types and what our viewers need to understand about them.
Yeah, so we're going to talk about the first one that I have here. It's called a single premium immediate annuity. Essentially, this is for just somebody who wants to create essentially a pension for themselves. They've got a lump sum amount of money. They put it into this contract. It's going to pay them a monthly income, potentially a yearly income, either for a certain time period or for the rest of their life. The next annuity we have is called a multi-year guaranteed annuity. I also like to call it a fixed annuity. And it's very similar to like a bank CD. It's going to give a guaranteed interest rate for a certain time period, 3 years, 5 years, 7 years, whatever you want from there. But the difference between that and a CD is it tends to have a little bit higher interest, usually somewhere between 0.5% up to 1.5% higher than a bank. And it has some more flexibility options. You could actually take a little bit more money out than you could with a CD during that period. The next annuity we talk about is called a variable annuity. Okay, and this is going to be for somebody who says, you know what, I don't want that fixed interest, I want to get some more growth. And so they participate in more of the market upside. Okay, in fact, they're invested fully in that market. Okay, and when you're invested fully in that market, that means you can get the market upside, but you could also take the market losses as well. Okay, and when we talk about that market losses, that market downturn that we see, there are a little bit of protections that you see in there. Generally, if the account falls below the amount of money you put in your principal and you die, they'll pay that to your beneficiaries. Now, if you have to die in order for a guarantee to kick in, I don't know how much of a guarantee that is, but, and then these accounts also have generally or on average, a higher source of fees than any of the other accounts that are there. But lastly, we've got is what's called a fixed indexed annuity. And this is really the fixed annuity and the variable annuity. If they came together and had a baby, it would be the fixed indexed annuity. And this is where we will participate with the market upside. Our interest is linked to an external index, like the S&P 500 or the NASDAQ. And we don't get all the gains of the market. We're limited by either a cap or a participation rate or a trigger from there. Kind of some of those accounts I was talking about a little bit in the beginning from there. But again, the idea behind that is it limits your downside. That means maybe we don't make any money in that year, but we can't lose anything we put in, nor what we earned.
Wow, and that's the difference, right? You're able to capture some of the upside, maybe not all of it, but then when the market does go down, you're not at risk of losing. That makes that a very attractive option for folks. And clearly it's important to understand about the different types and what they could do potentially for someone's situation, because not all annuity products are created equal.
Correct.
No, it's great. And so, folks, if you're at home and you're a little bit confused with some of these annuities, or you heard that they're all bad, or you're not sure of the ones that you have, if you have one and you don't understand exactly how it works, I'm going to encourage you to pick up the phone, give us a call at the team of ASC Financial Group, or use that QR code, scan your camera on that code, and we'll sit down with you. We'll explain to you the good, the bad that you have there, or how it could be really utilized for your retirement. And it could be a significant tool in your retirement outlook.
Wonderful. Josiah Taylor, thank you so much. I know we've got a lot more to get into today. And to our viewers at home, if this is resonating with you, maybe it's sparking some interest or some curiosity, and you're now asking yourself, could the right kind of annuity potentially be the right tool for me as part of my overall financial plan? We encourage you to reach out and schedule your time to come in and receive your very own complimentary retirement income analysis. 844-918-4867 is that number to call. Or if you'd rather connect online, simply scan that QR code and that will get you connected as well. Stay with us. We've got a lot more to cover on today's subject of could an annuity be right for you? Right after this.
My passion stems from my parents. So when my dad retired in the early 90s, he didn't have a lot of money accumulated, but he had a house. My dad was conservative. He never was a risk taker. So he placed his money in the bank, in CDs, and he lived off the interest along with a small pension and his Social Security and my mom's Social Security. And I went and visited them back in '99, and when the CDs began to mature, we realized that the renewal rates were much lower. I said, okay, let me take a look at your accounts. What I found was my dad at the time was 72. He had the portfolio of a 41-year-old. You know, very high risk, aggressive growth. And so I did a retirement income analysis, and we put them into a plan that gave them a predictable, guaranteed income every month. My dad lived to 92, my mom lived to 89, and they had a really, really stress-free retirement because of that guaranteed income. And so I'm passionate that I want to do that same job, that same strategy for the clients that I work with today.
Well, welcome back to Wealth After Work. I'm Kristen Oakley here with both Josiah and Taylor from ASC Financial Group. We're so glad you're joining us today. If you're just tuning in, we are unpacking all things annuities, the good, the bad, and the fine print. And we've discussed how not all annuities are created equal. There's different kinds. But what we really want to help you do is walk through some of these questions so that you can potentially answer, could an annuity possibly be right for you? And obviously so much goes into this, and we're going to hit this at a higher level. But I would love for you to answer this question. Typically, how is the right kind of annuity used in a client's investment and retirement plan?
Yeah, Kristen, well, unfortunately, one account can't be everything that we need, okay?
Right.
So it's really just understanding what are the goals, what are we trying to accomplish? So we look at it, are we disappointed maybe with the lower interest rates at the bank? Are we trying to look at some tax deferral? And I think we're gonna mention that a little bit later here too. Are we needing a stream of income we can't outlive? Or are we tired of the volatility of the market up and downs?
Right.
So depending on some of those questions we have, really determine, you know, what is the right one for me? Now, one of the big goals that people tend to have is getting that stream of predictable, guaranteed income. And that is something an annuity can provide. Now, I also want to mention that all annuities have the ability to what's called annuitize.
Okay.
And that's essentially when we are kind of giving up control of the money. We're saying we're going to convert it just to an income stream. We don't generally like to go down that road because if there's an emergency that happens, you tend to not be able to access those annuitized annuity.
Right.
But some of these will have an income stream. We can add an income rider. Some actually has a built-in one. And where you can get that income every month, every year for the rest of your life, of yours and your spouse's together. And then finally, even if you don't need the income, that growth option, but more of that safe growth option. As long as you're willing to maybe not get all the gains of the market and participate in some of the market upside, it could be a powerful tool to help navigate that volatility, especially if it's a portion, because now we're not having to make choices based on emotion or some misconceptions that we have out there. We can allow things to kind of ride a little bit better.
Right. So obviously so much goes into this to determining what kind of annuity and if it's right for someone. How do you all go about determining the suitability of this, if it's the right tool to help someone achieve their financial goals?
Well, we're fiduciary advisors, and so we always work in the best interests of our clients. We're required to, and we choose to. Right? So we need to ensure that anybody that's considering annuity knows the benefits and some of the areas that could be more of the cons, right? Or in what's the trade-off for the benefits that we get. For us, the most important thing is we need to establish a baseline. And for us, that baseline is our retirement income analysis. And again, if you're a regular viewer, I'm sure you hear us talk about this all the time, but it's such a powerful tool that we're going to look at how you're positioned. Are you maximizing income? Are you reducing risk? We look at what risk you're currently taking. We look at the tax implications of your money. We look at the fees that you might be paying. And then we look at, are you maximizing income? So that's step one. We need to see, where are you today?
Right.
We also want to gauge your risk tolerance. You know, how risk averse are you? And as we're approaching or we're in retirement, we want to work on reducing that risk. And that's an area where annuities, guarantees can be powerful. But once we establish that retirement income analysis, we want to work with folks on establishing their budget. What are their needs, right? And how much guaranteed income do they have today? What's their Social Security benefit? Do they have a pension? Do they have any existing annuities? And then is there a gap in our income needs from there? And that's what's going to inform whether or not an additional annuity may have some other powerful role to play in their overall income strategy. So we do all that. Then we look at some areas like joint income. This is the big one. Again, certain benefits are tied to, you know, a specific spouse and maybe not the other one, or the other one in a lesser degree. You know, when a spouse passes, you lose an entire Social Security benefit. When you have a pension, you may either not have a pension, a survivor benefit for your spouse, or if there is one, it's going to be a reduced benefit for the spouse. And so how do we make sure there's as little interruption as possible in someone's income picture when those situations in life happens, right? So we want to maximize joint income, and that's another consideration. What kind of joint income do you have now, and do we need to increase that? Now, the flip side, what's the trade-off for these benefits that we get in these guarantees? The biggest one's liquidity, right? So when you enter a contract with the insurance company, there's something that's called a surrender or a withdrawal schedule. And so there's a period of time, it ranges, but 5, 7, or 10 years in some cases, depending on the type of contract. And during that time, if you want to take out more than a certain amount of money in those times, and again, it varies based off of the type of annuity, there will be a charge that applies to do so, whether you get rid of the contract altogether or whether you take out more than what's allowed. And typically, all of these contracts allow for a 10% penalty-free withdrawal in a given year. But again, if you go over that or you move to something else, there may be a surrender charge to be aware of, right? So, you know, we have 3 goals for our money. We want our money to grow, we want it to be safe, and we want it to be accessible, right? And we want income. And so, you know, if I want my money safe and I want it fully liquid, I just put it in my checking account, right? But that doesn't, but we get pennies on, you know, pennies a quarter on our checking account.
Not much growth happening there,
If I want my money to be liquid and to grow, I put it in the stock market. But we don't have safety when we put it in the stock market. An annuity gives an opportunity to blend safety, growth, and liquidity and access together. Over time, these contracts become fully liquid, but if we're willing to maybe give up a little bit of full liquidity now in exchange for the growth and the guarantees that the annuity can provide, it can be a very powerful piece of someone's strategy.
And that's the key, is it's a piece, again, right? You would never tell anyone, oh, go ahead and put all your money in
Right,
there,
exactly.
right?
Exactly.
Yep.
Yeah. So that's where we just say, I mean, if you're a viewer and you're watching this today and you are wondering if an annuity is something that would be a part of your picture, if you have one already and you're just, it's a complex contract and you just don't understand what you may have agreed to or whether what you have is the best opportunity for you that exists today, we'd encourage you to reach out to us. We want to take you through that retirement income analysis. We want to take a look and go through and explain to you in layman's terms what the features and benefits are of either an existing annuity or one that you might be considering that's appropriate for you. And we want to really lead you through that process so that you're informed and have control as you move forward into retirement. So give us a call at the number on the screen, scan the QR code so we can get you that analysis.
Wonderful. Thank you so much, Taylor and Josiah. To our viewers at home, that number to call is 844-918-4867. Or again, you're welcome to scan that QR code. That will also get you connected to be able to schedule your complimentary retirement income analysis. We'll be back with more right after this.
When interest rates are low, you might be able to refinance your home, your car, or even your credit cards, because it could help you keep more of your own money each month. Yet, when interest rates go up, it may make sense to refinance your retirement.
Higher interest rates could provide income opportunities that you may not be aware of. What works for your portfolio during low interest rates may not work for you when interest rates are high.
Find out if a retirement refi could work for you. Call today for your complimentary Refi Your Retirement review.
Welcome back to Wealth After Work, where today we've been discussing all things annuities and how do you go about determining if the right kind of annuity could potentially be the right financial tool for you to achieve your financial goals. One of the things we need to talk about is the tax treatment of annuities. So what do people need to understand of and be aware of regarding how annuities are taxed and possible tax penalties as well?
Well, all annuities are tax deferred, so you don't pay any tax on any gains or anything until you actually take a withdrawal out. I think what it's important for folks to understand is that an annuity is really just a chassis, right? You still maintain the category of account within the annuity. So if you have an IRA and you put it into annuity, you're still subject to all the same requirements of an IRA. If you put after-tax money into an annuity, that's going to be a different tax picture for you than if you have qualified employer money. If you can put a Roth account into an annuity and it still grows tax-free just like a regular Roth account would. So the annuity is a chassis and then the characteristics of the account still remain underneath. So if you have your, you put your IRA, your qualified monies into an annuity, you still are subject to the RMD, right? So even if you haven't turned on income or you haven't taken anything out yet, once you turn 73, you have to take something out, according to the IRS, right? Pay the government their due. If you're in an annuity and you take a withdrawal out of that qualified annuity before 59 and a half, you're subject to a 10% penalty from the IRS, just like any other annuity. But ultimately, the monies are deferred and you don't pay tax until you actually pull income out. Then if you have an IRA where you put after-tax money, an annuity where you put after-tax money into this annuity, you only pay tax on the gains in that account. And so when you ultimately take income out of the annuity or take a withdrawal out, you're taxed on the gain portion. And the IRS follows a LIFO strategy, which is last in, first out when it comes to the gains within an annuity. So it's the initial withdrawals you take out is all treated as the growth that you've had within that annuity. So you'll pay tax fully on the growth. Once those gains or the growth is kind of exhausted out of the annuity, then the remainder is not subject to the same tax because it's the initial principal that you put in. Or premium that you put in. So that's a difference. Now, and if you have a Roth that you put into an annuity, we love Roths because they grow tax-free, they're distributed tax-free, and they're inherited tax-free. And the same thing applies if you have your money's a Roth account within an annuity, you have those same benefits and features that you would have if you had that Roth somewhere else in a different account. So again, it's important for folks to understand that the same kind of characteristics apply. the annuity is the umbrella, is kind of the chassis, and the way those monies are considered for tax purposes still remain once it's in the annuity.
That was a very helpful explanation. Thank you so much. And I know as we only have a couple more minutes left on today's show, but one of the things that you and the team of ASC Financial Group offer folks is a review of existing annuity contracts. And I'm sure some of our viewers watching might already have an existing annuity contract. Do you find that a lot of times when folks have those, they are confused about what they actually own? I mean, what does that look like when you do these reviews?
Kristen, I can't tell you how many times people are just completely confused and have no idea what it is, or they think they have one type and it's actually another. That's why when we do our retirement income analysis, part of that is actually what's called an annuity MRI, understanding everything inside of it. Oftentimes what that means is we'll call the insurance carrier. I don't want to call their advisor because I don't want to put them on the spot and make them kind of defensive or anything, but I want to understand what are the risks we have, what is the income it's generating, what are the fees that we're paying. And let me explain to you how this works, because we had a recent couple that came into the office. It was Steve and Joy from Mount Pocono, and they came in to see me. They wanted that retirement income analysis. And as I sat down with him, I talked to him. He had a substantial one, about $300,000 in a variable annuity. And one of the things I said to Steve is, I'm like, Steve, you understand you're probably paying about $6,000 in fees for this account? And he goes, oh, no, Josiah, I'm not. My advisor told me I have enough money over $100,000. I'm not paying anything on there. Like, okay, well, don't take his word for it. Don't take my word for it. Let's call the company and find out exactly.
Right.
Spoke to this nice lady. I asked her on the phone. I'm like, is Steve paying any fees on this? She goes, oh, no, there's an administration fee, but we waived it because, he has a good amount of money.
Right.
I'm like, oh, okay. Well, is there a mortality and expense fee? Well, of course there's that. It's 1.2%. Okay. Is there a rider fee? Well, yeah, he has that. It's 1.5%. Is there a sub-account fee? Oh, yeah, we have that. It's 1%. I was wrong. Steve wasn't paying $6,000. He was paying almost $12,000 in fees.
Wow.
Okay, Steve got so upset, and he's actually yelling at the woman, hey, tell me, where show me on my statement. It's not on my statement. She goes, these are internal fees. It comes off of your gains or adds to your losses. And he goes, well, why come nobody told me about it? She goes, well, sir, it's in the prospectus. They're like this big and they're buried in the middle here.
Tiny, small print. Yep.
But here's the thing, Kristen. It's all about knowing the right questions to ask.
Yep.
Okay?
So true.
And so, folks, if you are at home and you have one of these annuities, or you're thinking about getting one, you're not understanding maybe how it benefits you, what is the purpose of it? Are we looking for market risk protection? Are we looking for income planning? If we just don't know, I'm going to encourage you to pick up the phone, give us a call at ASC Financial Group. We'll provide you this retirement income analysis and also this annuity MRI to see if it is the right tool for you. But it starts with you first of picking up that phone and giving us a call.
Wonderful. Josiah Taylor, thank you so much. Thanks so much for watching. We look forward to being back with you next time here on Wealth After Work.